In exactly 23 days, everything changes. The Clarity Act goes to signature, institutional floodgates open, and Bitcoin's price discovery enters a phase we've never seen before. Bitcoin is sitting at $69,000, and the theories are going absolutely insane. Suppression by institutions, exchange insolvency, regulation games, quantum computing threats, and they're even linking Bitcoin to Jeffrey Epstein. Every explanation everywhere, all at once. And 99% of investors have no idea what's actually happening. The timeline for what comes next just collapsed from years into weeks. If you don't understand what's happening in the next 20 minutes, you'll be on the wrong side of the greatest financial redistribution of our lifetime. Welcome to the Wealth Continuum, where we expose the mechanisms that separate those who build generational wealth from those who watch it vanish. What I'm about to show you about February 2026 will fundamentally change how you view every financial decision you make from this moment forward. But here's what they're not telling you. As of today, February 7th, 2026, Bitcoin is trading at $69,000. To put this in perspective, just 4 months ago in October 2025, Bitcoin hit its all-time high of approximately $125,000. We're now down 45%. That's a $56,000 drop per Bitcoin. But here's where it gets really concerning. We're hovering right at $69,000, which was the previous cycle's all-time high from November 2021. We're testing this critical psychological level that held as resistance for years. Think about that. 5 years of progress, and we're back at a level that once seemed impossible to break through. Now, I need you to understand something crucial before we go further. This isn't just a Bitcoin story. In the last 24 hours alone, nearly $5 trillion was wiped out across global markets. Gold, silver, stocks, bonds, everything sold off simultaneously. And it all happened without a single clear major catalyst. This is what broad de-risking looks like. This is what financial stress looks like when it moves through the entire system. Stay with me, because the next part is crucial. But here's what's different about this drawdown. The selling hasn't been emotional. It hasn't looked like retail panic where amateur investors dump everything in fear. Instead, it's been steady, methodical, and surgical. Lower highs, lower lows, day after day for 9 straight days. That pattern tells you something critical about who's selling and how. This isn't your neighbor panic selling his Coinbase portfolio. This is what veteran traders call campaign selling. Coordinated institutional level selling with a purpose. And before anyone thinks I'm here to sugarcoat this, let me say the part that needs to be said. Bitcoin can absolutely go lower from here. One critical level I'm watching is the 200-week moving average. Could we go there? Yes. Could we briefly go even lower? Also, yes. Comment below if you're watching that $58,000 level, or if you think we'll find support before then. You need to understand this before I show you what's next. Let's talk about something technical that actually matters. The Relative Strength Index, or RSI. Don't let the jargon intimidate you. RSI is simply a measure of how intense and one-sided the market has become. Right now, Bitcoin's RSI is lower than it was during the COVID crash in March 2020. Let me repeat that. It's even lower than it was at the absolute bottom of the FTX collapse in November 2022, when one of the world's largest exchanges imploded overnight. What does this tell us? Fear, forced selling, and liquidation pressure are at extreme levels. And here's the critical insight. Historically, these extreme oversold conditions don't show up at the start of drawdowns. They show up much closer to exhaustion, when sellers are running out of ammunition. This doesn't guarantee we've bottomed. It doesn't call the exact turning point. But it does tell us that the market has become extraordinarily one-sided. And that's important context before we start layering on all the theories and narratives. Think about the psychology here. When RSI reaches these extreme levels, it means for every buyer stepping in, there are overwhelmingly more sellers pushing out. That imbalance can't sustain itself indefinitely. Either new sellers enter the market with fresh supply, or the selling exhausts itself. We're seeing similar patterns across multiple timeframes. The daily, weekly, and even monthly charts are all showing extreme oversold conditions. This kind of alignment across timeframes is rare. It happened in March 2020. It happened in November 2022. Both times marked significant bottoming processes. Now, does this mean we bottom today, tomorrow, or next week? No. Markets can stay oversold longer than you think, especially when fear is the dominant emotion. But it does tell us we're in territory where historically, patient capital has been rewarded. Because whenever price breaks confidence like this, the theories rush in like a flood. So what's actually driving this? Depending on who you ask, you'll get a completely different answer. Some say it's intentional price suppression by large institutions and banks. The theory goes that they're driving prices lower before regulatory clarity arrives. The Clarity Act is expected to be signed into law by the end of February 2026, and some believe powerful players are accumulating at suppressed prices before the narrative flips and shorts get destroyed on the way back up. Think about the timing here. We're potentially weeks away from the most significant pro-crypto legislation in United States history. The Clarity Act would provide legal certainty for digital assets, clear regulatory frameworks, and institutional on-ramps that don't currently exist. If you were a multi-billion-dollar institution that understood this was coming, what would you do? You'd want to accumulate as much Bitcoin as possible before that clarity arrives, and prices reflect the new reality. The methodical selling we're seeing could be one side of this trade, creating the conditions for accumulation. Others point to exchange insolvency rumors. Binance has been mentioned repeatedly following the January 10th, 2026 incident, with concerns about liquidity withdrawals and questionable order books. When the world's largest cryptocurrency exchange by volume starts showing strain, it creates uncertainty that ripples through the entire market. Are these concerns legitimate? Maybe, maybe not. But perception drives price action in the short term, regardless of underlying reality. Then you've got the persistent fear, uncertainty, and doubt flooding every corner of the internet. Suppression theories claiming powerful entities are manipulating price. Exchange insolvency rumors suggesting major platforms might be on thin ice. Regulation games where governments are supposedly coordinating attacks. Quantum computing threats claiming that future quantum computers could break Bitcoin's encryption. Whale-selling narratives suggesting large holders are dumping their positions. Mainstream media hit pieces that seem coordinated in their timing and messaging. And even absurd conspiracy theories linking Bitcoin to Jeffrey Epstein, with some people actually claiming Epstein was Satoshi Nakamoto, which is absolutely ridiculous. Every explanation everywhere all at once. Every angle, every day, no pause. The information warfare is relentless. Here's the key thing you need to understand. Some of these theories might have elements of truth. Some are definitely ridiculous fear-mongering designed to shake weak hands. And some might be a mix of both, containing kernels of truth wrapped in exaggeration. But here's what they're not telling you. None of them change what Bitcoin fundamentally is. None of them alter its supply cap of 21 million coins. None of them modify its decentralized architecture. None of them break the mathematical certainty of its monetary policy. Bitcoin continues to produce blocks every 10 minutes, just as it has since January 3rd, 2009. The protocol doesn't care about narratives, fear, or price. It just works. And that's the grounding we all need right now, because the noise is designed to make you forget the signal. When markets get chaotic like this, something very predictable happens. Everyone starts looking to the Federal Reserve. And if there's any one neat narrative that started this unwind, it was the announcement of Kevin Walsh as the new Federal Reserve Chair earlier this year. This set a different and unexpected tone, and markets began pricing in the idea that maybe, just maybe, policymakers could steer things differently this time. Walsh has a reputation as an inflation hawk, someone who prioritizes price stability over asset prices. Markets interpreted this as a signal that easy money policies might actually end, that quantitative tightening might continue. But that's the irrational mistake, because regardless of who sits in that chair, the fundamental constraints don't change. The debt doesn't disappear. We're sitting at approximately $35 trillion in federal debt as of February 2026. The deficits don't shrink. We're still running roughly $2 trillion annual deficits with no credible plan to reduce them. The math doesn't reset just because a new person occupies the chair. Think of it this way. There are 4 doors the government can walk through to deal with our debt crisis. Door 1, austerity. Cut spending dramatically. Both parties have proven they won't do this. We tried with government efficiency initiatives in early 2025. Despite all the talk, all the commissions, all the promises, we're still running $2 trillion annual deficits. The political will simply doesn't exist for the kind of cuts that would actually matter. Cuts to Social Security, Medicare, defense spending, and interest payments, which together comprise the overwhelming majority of the federal budget. Door 2, raise taxes. Politically unpopular and economically counterproductive beyond a certain point. We're already seeing billionaires and high net worth individuals fleeing high tax states like California and New York for Florida, Texas, and Nevada. This isn't just anecdotal. The migration data is clear and accelerating. Beyond that, there's a well-established economic principle called the Laffer curve that demonstrates there's a mathematical ceiling where higher tax rates actually reduce total revenue because they kill productivity, discourage investment, and drive capital to seek more favorable jurisdictions. You can only tax productivity so much before you start destroying the very engine that generates tax revenue in the first place. Door 3, default on the debt. This is the nuclear option that would destroy the credibility of U.S. Treasuries, collapse the dollar's reserve currency status, and trigger a global financial crisis. And here's the thing. You would never choose to default on debt that's denominated in your own currency. Why would you? When you control the printing press, default makes no sense. Door 4. Print more money, expand the money supply, create inflation, devalue the debt through currency debasement. 3 doors are locked. Only one remains open. And we're walking through it right now, whether Federal Reserve officials admit it or not. This is where it gets really concerning. Right now, in February 2026, the Federal Reserve is conducting what they call regular market operations, buying Treasury bills to ensure bank reserves stay high enough to support economic velocity and maintain financial stability. But let's call it what it actually is, QE light. Quantitative easing by another name. The mechanics are identical. The Federal Reserve creates new money and uses it to purchase government securities. They have just changed the branding to avoid the political baggage that comes with admitting they're back to printing money. And here's what the market is telling us through the bond market, through yield curves, through credit spreads. Eventually, they're going to have to buy longer dated treasuries. They're going to have to implement what's called Operation Twist, purchasing long-term bonds specifically to control yields and prevent interest rates from spiraling upward. That's full-on quantitative easing. That's yield curve control. That's direct monetary intervention on a massive scale. Why is this inevitable? Because as the federal debt continues to grow and deficits remain structural, the government needs to continuously roll over existing debt while issuing new debt. As of early 2026, the U.S. is paying over $1 trillion annually just in interest payments on the national debt. If bond yields rise significantly, say the 10-year Treasury moves above 5% or 6%, those interest payments would spiral upward catastrophically, consuming an even larger portion of the federal budget and creating a self-reinforcing debt spiral. The Federal Reserve cannot allow that to happen. They're boxed in. Maybe it takes a triggering event, a failed Treasury auction, a foreign creditor reducing holdings, a spike in inflation expectations. Maybe it just takes the 10-year Treasury yield hitting a certain pain threshold that makes debt servicing unsustainable. But the math says they have no choice. The system's constraints are mathematical, not political. Kevin Walsh might be known as a hawk who talks tough on inflation and monetary discipline. That's great on paper. It sounds responsible. It placates certain constituencies. But when you're boxed in by $35 trillion in debt, $2 trillion annual deficits, $1 trillion in annual interest payments, and no political will for the kind of austerity that would actually matter, your options disappear. You can be the toughest, most hawkish central banker in history. But if the math doesn't work, the math doesn't work. The system is constrained by mathematics, not personalities or intentions, and Bitcoin exists precisely because door 4 always wins. It has always won throughout monetary history, from the Roman Empire debasing their denarius to Weimar Germany's hyperinflation, to every fiat currency that has ever existed eventually losing purchasing power. The only variable is timing. Share this with someone who needs to see it, because this next insight changes everything. The hardest part of moments like this isn't the price action. It's the doubt that creeps in, that uncomfortable feeling that maybe you're wrong, that maybe everyone else knows something you don't, that maybe you've missed some critical piece of information that makes Bitcoin not what you thought it was. This psychological pressure is intense and real. When you're watching your portfolio value decrease 20%, 30%, 40%, 50%, your brain starts playing tricks on you. It starts searching for reasons why your analysis might be flawed. It looks for exit ramps from the discomfort. But what we're experiencing right now is what's called a knowledge arbitrage. A knowledge arbitrage means the price is moving before the understanding has caught up. It means there is a gap between what something is worth based on its fundamental properties and what the market is currently pricing it at. And that gap exists because of asymmetric information and understanding. It means some people, maybe you, maybe me, are looking at Bitcoin through the lens of monetary history. Game theory, network effects, stock-to-flow ratios, incentive structures, cryptographic security, and mathematical certainty, while most people simply aren't. Most people still see Bitcoin as a trade, a way to make quick money, a tech stock that moves with the NASDAQ, a gamble, or just another speculative cryptocurrency in a sea of thousands of worthless tokens. They're not asking what fundamental problem Bitcoin solves. They don't understand the difference between decentralized proof of work and centralized pre-mined tokens. They're not looking at it through a lens of debt cycles, currency debasement, or broken monetary incentives that have existed since governments abandoned gold backing. They're not thinking about what happens to purchasing power over decades. They're not thinking multi-generationally. They're thinking about next week's price movement. So when price drops, like we're seeing in February 2026, they don't have a framework to lean on. They have no foundation beneath them. They just feel fear or revulsion, and they sell to make the psychological discomfort stop. That's why this phase feels isolating. That's why it feels like you're crazy when you're still bullish while the price is down 48%. Because when you understand what Bitcoin actually is, when you understand it is the first provably scarce digital asset in human history, the first form of money that can't be confiscated or inflated by any government, the first truly global settlement layer that operates 24/7, 365 without permission. Drawdowns like this don't feel like failure. They feel like friction. They feel like the gap between price discovery and fundamental understanding being worked out in real time. They feel like opportunity. Understanding always lags price, and it lags the most when price is falling. Because that's when people are least willing to do the intellectual work required to truly understand what they're looking at. At market tops, everyone thinks they understand Bitcoin. They're confident. They're euphoric. They're experts at dinner parties explaining cryptocurrency to their friends. At bottoms, almost no one does. The fair weather experts disappear. The tourists leave. Only those with genuine conviction forged through study remain. That's not an accident. That's not a bug. That's how monetization works for something that's genuinely new and disruptive to existing power structures. The printing press, the automobile, the internet, every transformative technology went through cycles where the crowd alternated between euphoric over-optimism and complete rejection. If this feels uncomfortable, if it feels lonely, if it feels like you're too early and maybe you've made a terrible mistake, that's not a sign you're wrong. It's a sign you're ahead of the curve. It's a sign you're in the knowledge arbitrage phase where your understanding exceeds the market's current pricing. The question is whether you have the conviction to hold that understanding when everything around you is screaming doubt. Here's something that doesn't get talked about enough, but it's one of the most bullish indicators that exists. Look at the quality and diversity of people who have become Bitcoin advocates. Tunnel engineers, doctors, energy traders, scientists, entrepreneurs, philosophers, software developers, mathematicians, economists, historians. People from fascinatingly diverse backgrounds, all with different expertise, all using different analytical frameworks, all starting from different ideological positions, and yet they've all independently converged on the same conclusion. Bitcoin represents a 10x improvement over its predecessor systems. And history shows us something very clear. When technology evolves to a 10x multiple over what came before, when it's not just incrementally better but fundamentally superior, it takes over. The automobile over the horse and carriage, the smartphone over the flip phone, digital photography over film, email over postal mail. Bitcoin is 10x better than fiat currency, provably scarce versus infinitely inflatable, permissionless versus requiring approval, censorship resistant versus easily frozen, globally accessible versus restricted by borders, mathematically certain versus subject to political manipulation. Are you telling me that all of these intelligent people from completely different fields are just wrong? That they've all been fooled by the same delusion? Consider this. Most Bitcoiners formed their conviction during an era when the world hated Bitcoin. Every major headline from 2013 to 2020 was negative. Governments were banning it. Media was mocking it. Friends and family were telling us we were crazy. And yet, we independently formed enough conviction to put significant portions of our wealth into it anyway. That's not groupthink. That's independent verification of a thesis using different analytical frameworks while the entire world was screaming that we were wrong. I'm not betting against those people. They understand something fundamental about how money works, how power works, and how technology disrupts entrenched systems. Riding Bitcoin through cycles is a rite of passage. It separates people who understand what they own from those who are just chasing price. And I genuinely believe we'll look back at February 2026 the same way we now look at March 2020 or the FTX collapse in 2022 as obvious buying opportunities that only became obvious in hindsight. Moments like this don't reward perfect timing. They reward discipline. That's why dollar cost averaging matters here. Not trying to catch the exact bottom, not reacting to every headline, just consistently converting excess capital into Bitcoin while staying focused on the long-term thesis. This is also where self-custody becomes non-negotiable. If this is something you plan to hold for decades, if this is about generational wealth, it cannot live on an exchange where you don't control the keys. Bitcoin held for the long term needs to be secured properly, with a real plan for inheritance and estate planning. Otherwise, you don't truly own it. Now let's zoom out. There's a lot of extreme fear floating around right now. Some of it goes too far. But the reason it's landing isn't really about Bitcoin. It's about what people are being forced to confront about the systems they live under. Recent revelations, corruption, abuse of power, moral decay at the highest levels have pulled back curtains most people never wanted to see behind. That kind of exposure destabilizes people. It shakes trust. It disrupts their understanding of how the world actually works. Here's the key thing to understand. The fiat monetary system doesn't just manage money, it enables power. It concentrates control, it rewards insiders, and it quietly extracts value from everyone else through inflation and debasement. This isn't conspiracy theory. It's how centralized monetary systems have worked throughout history. Bitcoin is an exit from that system, not a cure-all, not a moral crusade, but a way to opt out of money that can be manipulated, censored, or inflated behind closed doors. Bitcoin is neutral. It's an honest ledger. It's what ancient wisdom called just weights and measures. Honest money doesn't fix human corruption, but it limits how much damage corruption can do at scale, and that's why Bitcoin exists. Not to promise a perfect world, but to give people a tool to protect themselves from a system that demands blind trust while quietly rewarding abuse of power. So let me ask you, what do you think is driving these drawdowns right now? Institutional pressure, Fed policy, exchange risk, or just normal market cycles doing what they always do? And if you've lived through previous Bitcoin bear markets, what helped you hold conviction when it felt darkest? Drop your thoughts in the comments. I genuinely want to hear them. If this brought you value, hit the like button. It helps this reach people who need clarity when the headlines are screaming chaos. And consider sharing this with someone who's feeling uncertain right now, someone questioning everything. Subscribe to the Wealth Continuum if you want analysis that cuts through noise and focuses on preserving purchasing power across generations, not chasing short-term hype. Here's the bottom line. This is what capitulation feels like in real time. This is knowledge arbitrage playing out. This is the gap between price and understanding. And this is exactly why Bitcoin exists. The system is constrained. The math is undeniable. Door 4 is the only one still open. The only question is whether you understand that deeply enough to act now, or whether you'll wait until everyone else finally gets it and the price reflects that understanding. Until next time, stay informed, stay rational, and keep building.